SCHD is a good investment option amid uncertainties about a possible recession ahead. And the ETF's price is still lagging behind the overall market, which means it could still be a great buying opportunity for long-term investors looking to get in. The ETF's low expense ratio of just 0.06% and a diversified portfolio of dividend-paying stocks from various sectors make it a great option for long-term dividend growth investors. But there are still some risks associated with the Schwab Dividend Growth ETF, which we are also going to go over, along with why so many investors choose to invest in this ETF rather than dollar cost averaging long-term into the S&P 500. Now we're going to go over all this and more right after you please drop a like on this video and subscribe for more content like this in the future. So a lot of investors are honestly confused on why the SCHD ETF is so dang popular. Well, SCHD was conceived by a leading asset manager at Charles Schwab back in 2011. Now, SCHD seeks to track the total return of the Dow Jones US Dividend 100 Index. This makes for a passive nature of SCHD's fund management style, resulting in a very cheap, low expense ratio of just 0.06%, which means long-term investors that are planning on stacking more and more shares of SCHD long-term are going to keep more of their money year after year. With this low of an expense ratio, keep in mind, this makes SCHD's fees around 88% below the ETF industry median, which is actually around 0.49%. So most ETFs out there are charging you around 0.5%, where SCHD is just 0.06. Now some more highlights about SCHD. There's around 651 million shares outstanding and about 47.2 billion in total net assets. Now SCHD's current trailing 12-month dividend yield is around 3.8%. So this is one of the few ETFs across the entire stock market, which investors can buy into and receive a very nice starting dividend, but also be attached to a high quality ETF with some massive capital appreciation as far as historically speaking. SCHD as far as share price is up 176% as far as all time, and that's just over around 10 or so years. Now, it's also important to note that unlike the US Dow Jones Broad Market Index, SCHD does not contain any REITs or master limited partnerships. This reduces tax inefficiencies associated with things like REITs due to their dividends, which are mostly taxed at ordinary income rates, and with the tax complexities surrounded around MLPs, which are master limited partnerships. The SCHD ETF keeps it simple, which is another reason why investors love it. Now this ETF carries a well-rounded basket of dividend-paying and also dividend-growing stocks in different areas like industrial, healthcare, financials, consumer defensive, technology, and more. And to look into what the actual top 10 holdings of the SCHD ETF are, they're currently Broadcom, Merck, Verizon, Texas Instrument, UPS, Cisco, The Home Depot, PepsiCo, Coca-Cola, and AbbVie. And these top 10 holdings can be ever-changing during SCHD's yearly Reconstitution, where different companies are weighted differently at times, and different companies, different names can switch out. Now, for those that might not know, a Reconstitution typically refers to the process of rebalancing or adjusting a portfolio or investment strategy to align with a predefined schedule or target or strategy. And this is commonly used in the context for exchange-traded funds or ETFs. Now, when an ETF or index fund is created, it aims to track the performance of a specific index or benchmark. However, over time, the weights of the individual securities within the index may change due to factors such as market fluctuations, corporate actions, or changes in the index methodology. Now, for SCHD specifically, the Reconstitution involves periodically reviewing the composition of the underlying index and making necessary adjustments to the ETF or index fund's holdings to bring them back in line with the target index. Now, during this process, the fund is going to be buying or selling securities to adjust their weights and ensure the fund's performance remains in line with the index that it tracks. Now, the fact that SCHD's portfolio of dividend-paying stocks has grown way faster compared to all ETFs with a 3 and 5 year dividend growth CAGR of 12 and 14%, which means that SCHD has blown mostly all other ETFs out of the water in that time period, at least if we were to compare other favorable ETFs, which have around a 6 to 7% CAGR in the same time periods. Now, what this basically means for investors, especially long-term investors, if you were to bought into SCHD a while ago, you would have gotten paid a quarterly dividend every single quarter since then. But on top of that, this ETF would have paid you more and more and more historically. And although past performance does not indicate future performance, meaning that just because this ETF has raised the dividend so quickly, historically speaking, does not mean that it's going to continue to do so at the same rate. But what it does mean is that this ETF does have a track record of extremely fast dividend growth because of the strategy that this ETF has. So investors are likely going to get paid more and more the longer they hold onto this ETF, at least if history was to repeat itself. Now let's talk about some of the risks around SCHD. Some of the risks include obviously the potential for a recession ahead, which depending on the severity could impact all the stock prices and nearly all of SCHD's assets, especially the financial portion of the ETF. And SCHD does hold some bank stocks, and we've talked about this in previous videos. And because earlier this year, the financial industry was so shooken up, it really drove down SCHD's overall ETF price, which in my humble opinion, made it a great buying opportunity for a long-term dividend growth investor. Now, another risk, obviously, with a future recession ahead possibly, is the fact that SCHD's dividend growth could be dramatically slowed down. Now, investors are hoping that it's not slowed down below the previous 3 and 5 year growth rates. But with a recession ahead, a possibility of one, it definitely could happen. But even with the risks of a possible recession ahead, these risks shouldn't have a long-term lasting impact on SCHD holdings, considering their size and the diversification that the fund has. Because after all, SCHD does carry a lower risk than many other ETFs in its class. If you look at the standard deviation and the short interest, they're both rated B and A- on Seeking Alpha, which puts them in a pretty favorable spot. Now, the last thing I want to talk about is something that a lot of long-term dividend growth investors and growth investors bring up quite often. It's the argument that if you're such a fan of SCHD, and let's say you think it's going to do great long-term into the future, then why would the investor not want to just buy or dollar cost average into the S&P 500 long-term, which likely is going to slightly outperform SCHD long-term? Now, I will say a lot of investors that argue this might have a good point. In my opinion, the S&P 500 might slightly outperform SCHD long-term, is that some more income-oriented investors like myself are willing to pay a price of slight outperformance in order to receive a higher dividend along the way. Instead of dollar cost averaging your entire way up until retirement, investors like myself would rather build a long-term cash flowing dividend-oriented portfolio, which can pay us on a monthly or quarterly basis, and use some of this money to pay for bills or to just enjoy life, whatever it might be. And with the S&P 500 starting dividend yield of just 1.47%, where SCHD has a starting dividend yield of closer to 3.56%, it's pretty obvious that investors that buy into SCHD rather than the S&P 500 are going to be receiving around twice as much as far as quarterly dividend payouts compared to those investors that would have bought into the S&P 500. So the idea is that SCHD is what we could call the golden goose, which lays golden eggs every single quarter. And again, likely they're going to pay you more and more. Instead of just buying into the S&P 500 and then selling off your shares of it as you get closer to retirement or whenever you want some of the money, by investors buying into something like SCHD, which does pay a higher dividend, investors are going to be receiving that golden egg every single quarter. But I want to hear what you guys think down below when it comes to the SCHD versus S&P 500 long-term investing strategy and what you personally favor more. A small bit of outperformance, or if you like me also want to receive those golden eggs a lot sooner. If you enjoyed this video, make sure to please drop a like on the video and subscribe for more content like this in the future. Thanks for stopping by, guys, and I'll see you in the next one.